Hi, good morning, everyone. Thank you for tuning in early birds. Good morning to you. Well, it's noontime for most of you. Uh, we'll start early, couple of minutes early while we wait for people to tune in. So, yeah, how's this Sunday so far? Hope you're doing well. Prep up, grab a cup of coffee or something. We're gonna have a good time. Just running through the charts, studying and learning some advanced techniques that I do not necessarily have the time or bandwidth on the trading day to run through. Yeah, just checking in. Thank you for your well wishes. I'm feeling so much better. The fever's gone, so that's a good thing. I guess rest is really that important. I managed to see that the swelling near the neck has reduced. I still feel a little swollen near to the right collarbone, but generally speaking, I'm all right. I think I'm good. So yeah, you can hear that I sound much better too. Well, thanks to you. So thank you for your prayers, your well wishes. I'm feeling really good. So I'm ready. It's a new week coming. It helps that Friday's trading was gave me the adrenaline to endure the pain, isn't it? Friday was really fun. I want to run through Friday, obviously. Lots to learn. And, well, I will start in another minute. So get ready. Please do not share this link if you have it. It's not meant to be for public consumption. It's meant for you if you're in the Discord server. Now I'm reading the comments. I've put it in, once again, low latency. So I will read your comments quite swiftly whenever I can to catch up. So if there's anything you would like me to touch on or elaborate, I certainly will try my best. I apologize in advance if the pace and the context don't allow me to always necessarily answer your question. So I beg your pardon for that. But otherwise, yeah, let's get it started at 12 noon now. So let's start. Let's go. Right, I'm running through Friday for now, and thereafter trying to run through the rest of the day. There are several things I want to run through on Friday. Something more special, right? I want to be running through, well, firstly, running through the credit spread concept that I talked about on Friday. So if you remember this, I talked about it here. Right, so this was the credit spread that I took. Right, I also suggested that in the live stream video in the morning. So let's talk a little bit about that as well. Next, I want to, so that's the credit spread I want to talk about. Now, next I want to talk about some very key concepts here in price action. Let's talk about price action. Let's talk about some of your trading decisions that you can necessarily make here, right? I want to run through, have a little rundown here. And lastly, I want to run down the final 10 minutes right here, right? Whether the final 30 minutes might as well, whether it's viable. It's a viable trade. How do you tell whether it's a viable trade and whether you should be trading this at all? So let's talk about that too. Now on Friday, it's quite straightforward. It's a catalyst day. So generally speaking, you have to always check your calendar. You've got to know if there is going to be big movements in the market. especially when you're trading options, you need to have very, very deep understanding of what will move the market, because this will affect something called your implied volatility. In short, it's known as your IV, right? So implied volatility is basically pricing in your options. So you realize that on Friday, for example, your options are slightly more expensive, right? So your premiums, or the cost of your options, are higher, especially before 10 a.m. here, before this large green candle that happened. Let me see that here, especially here. Now, right here, when your IV is high, what does that mean? Generally speaking, it just means that the options are priced in to move at a large expected range. So for example, in an ordinary day where there is slightly lower IV or normal IV, say the spot price right now, right? Say SPY is trading at 684, just for example's sake, right? I'm just rounding it up. And if you're buying something off the strike, like for example, 20-day moving average, something very straightforward, like say your 689 calls right here, right? Now, say your 689 calls on a normal day. I'm just taking this off. I have no idea what's the exact amount then. But say this is, let me just do a quick calculation. It's 5 points out of the money. 5 points out of the money in the start of the day. I would guess it's probably $3 for SPX, right? But given it's a catalyst day, the expectation that the possibility of this getting there is much higher. And so more people are willing to buy. And when there's more people willing to buy this contract, this 689 call, this price will be bidded higher. You understand the logic behind that? So in a day where there is an expected bigger move, right, implied volatility will be higher. More people will want to bid for this current contract. And so on that day, if I'm not wrong, this is probably $8 to $10, if I'm not wrong, right? So you realize that on a normal day, the likelihood of getting there is low, but on Friday, you see it 2 times more in the price. Now, this is significant, right? Because if you are wrong, you have to understand this. You are already 5 points out of the money. 5 points. We're talking about 5 points out of the money. If you trade SPY enough, and you have to trade with me every day, you realize that the expected range every single day, it's about 2 to 3 points, 3 to 4 points now that we are in the 600s, 700s, right? So we're talking about percentages, right? It's very, very rare. We have 2% days, very rare. Not for SPY, very rare. 2% red or 2% green days. Now we're usually about 0.5 to 1% day, right? So even a 1% day is a 6.8 point move right now. That's a lot, right? So 0.5 to 1%, that's fair enough. So a 5 point move, that's quite unlikely. So you imagine if this goes against you, right? Your IV will be absolutely crushed. So this is why times when the premiums are high, it's better to just step away, right? Especially if you're trading 0 day to expiry. It just doesn't make sense. You don't have clear structure, right here. You don't have, because you're in the early. Now listen to me here. This particular portion here. If you're trading the early candles, right, the strike price somehow doesn't matter. Hear me out. Because when you're trading at the early candles, when the market has not decided where to go, right, the contracts have intrinsic value still fully loaded at the start of the day, where the market is indecisive, not clear where to go yet. What you're trying to do is you're trying to earn from the arbitrage, the quick arbitrage. You understand that? So it doesn't matter, because you're playing around with the delta, Now I'm going to explain this a little bit deeper. So once again, just to recap this, early candles, right, when intrinsic value, extrinsic value is still fully loaded in the 0 day to expiry, because this is just the start of the day, right? What you're making money from, generally speaking, it's nothing to do with the strike. It has to do with your arbitrage. Quick in, quick out, you take the money from the difference. The word arbitrage means the difference, right? The difference in the price, right? So if you bought it low, you sell it high, this is the difference, right? The difference is your profits, and this is known as your arbitrage. So you're trying to make money from the arbitrage using delta as a reference. So it doesn't matter, even if you took something way out of the money. Say I took something here, 691C, and spot price is once again 684, right? This is 7 points away. You're probably going to be extremely out of the money, right? It's probably going to cost you, what, 50 cents? $1 on SPX? It's going to cost you nothing. Why take a strike like that? Usually it's because you have a small account. But this doesn't matter. What you need to worry about is your delta, because your delta will tell you how much you're going to make for every move. Now remember, I always tell you, you have to calculate this beforehand. You need to have a certain template with a certain table of the prices based on your account size, right? You need to know the number of contracts you have to take. You need to know the delta you're allowed to take. You need to know what is the points you're allowed to move. So I keep this consistent, right? I tell you 0.5 to 1 point is all you need. I always tell you that, right? Now you work backwards from there, how much profits you want to be making. Now you realize I sometimes make it a round figure. I like to keep it a round figure. 10,000 profits, for example. So it's easy for me to calculate this. Now remember I told you this. If I want $10,000 profit, wait, let me just do this a little bit more clear. So the number of contracts, right? So that's your first column. The second column will be your delta, right? That's the second column. The third column will be expected move, how much you want it to move. And the last column will be your profit, right? You need to work out a table for yourself. This is important. So say I want $10,000 profit, right? $10,000, right? I want the expected move. I just needed 1 point. Let's work backwards, right? Now, my delta, if I take something deep in the money, right? So say I take, for example, say just 0.5 delta, right? Just 5 delta, right? Let's just use that as an example. Now, how many contracts do I need to take in order to take a $10,000 profit if I want it to move in 1 point? 1 point move. Can you calculate this for me? Tell me in the comments. Let's see who can get this. In the YouTube comments, yes, if you can comment it. Okay, SPX, of course. SPX, yes, I do SPX, right? So, for example, 1 point move. 1 point move on SPX is $10, right? $10. 0.5 delta means I will make $5 off that $10 there, right? $5, you have to multiply by 100 because you're representing 100 shares. So that's $500 per contract. So if it's $10,000, I need 20 SPX contracts. Well done. Well done. Well done. Good job. You get it. You understand that. So that's the expected move for 1 point. You understand that, right? This is the SPY expected move, and this is the number of contracts for SPX. You understand this now, right? Work it backwards. Now, you need something that is in a round number, so it's easy for you to do your mental calculations. So there are some homework you need to do prior to trading, and this is why you need to paper trade first. You need to first have a simple understanding, right, of your style, of your number of contracts, and how you're going to work things out from there. So you understand now, it depends on your arbitrage. Now for me, if it's a 0.5 delta, right, your contract moves more significantly, right? So I'm able see how much I can afford this. So if the contract's at that point in time, say it's priced in at $25 for SPX, right? That's $2,500. No, $2,500. How much capital do I need just to take this trade, right? So my full capital, I will need $50,000 just to take this trade. May not be a good deal, isn't it? Now, if I'm not wrong, on Friday, something that's 0.5 delta, if I'm not wrong, is about $35 to $40. That's quite expensive, and it moves against you in the same delta as well. So you have to be very careful, because once the news goes against you, right, you lose not just the intrinsic value, but especially the extrinsic value. Because, for example, okay, you're done with this part. I will come back to this, yeah? Because, for example, if the IV is extremely high here for both ends, right, and the news turn out to be a good news, you will get something known as your IV crush, right? The market knows it's never returning back down because it's great news. So what happens? You completely lose the extrinsic value of your contracts. So you get crushed. So once you're wrong, it's very, very pricey, extremely pricey. And so this is why you have to learn to take something called spreads. That's what I'm going to teach you now. You take something called a spread. Right, that's your way of trying to fight against IV crush, especially if you're right or wrong. Okay, so you take both ends if you want to, right? Some of you, if you want to take one end, it's fine too, right? I will teach you a strategy behind both of that, right? Or you start scaling down. Well done, that's right. So that's a very good tip. So you start scaling down. It's fine. You don't have to make big money. Your usual contracts, because the market will move in a larger magnitude. Now, remember that table earlier. That's very important information, because this table, you needed to pre-calculate your default trading templates. You understand that, right? So it's better when you have certain number of contracts you take when it's 0.3 3 delta, or 0.5, also known as 5 delta, or you take it at 0.2, 0.1, 1 delta, 2 delta. So it also depends on your account size, right? Because some of you have a small account. You obviously will take something. You either take something with low delta at the start, or you wait for end of day to start trading. Because at end of day, a 0.5 delta can be as low as $1 in SPX. It can be, right? Because we're nearing end of day, the contract no longer has an extrinsic value or time value, right? And the intrinsic value is extremely low because it's out of the money. You're trying to play for it to get in the money. You understand what I mean? Let me repeat that. You're trying to play for the contract to get in the money. So therefore, it can be cheap, even though it has a slightly higher delta compared to at the start of day, a 0.5 delta or 5 delta at the start of day. The triangle is delta, all right? A 0.5 delta at start of day can be $3 to $5 in the SPX. Now, you understand that logic, then you know how to be strategizing, especially if you have a small account. Now, so far, can you understand that? And give me a response in the chat, please. YouTube chat. try to keep this interactive, right? So I have better understanding, and you know that this is not pre-recorded. Yep. Okay, thanks. I really appreciate it. Now, so it's important, right? If you're trading futures, sure. I mean, it's much easier to manage the arbitrage because you're literally buying low, selling high, right? But with options trading, as I mentioned, the fact that you learn the difficulty in the initial difficulty or the learning curve in options trading, you will be able to move on to more advanced concepts that truly is, I believe, the way to accumulate wealth. So it is so layered, options trading, that you can use it as a tool to accelerate your wealth even more, right? And you can see that because the risk to returns here on day trading, whether it's in day trading, options trading when day trading is just insane leverage. I explained this in the previous live stream where I talked about accelerating your money, right? The leverage in the day trading, especially 0 day to expiry, is just absolutely insane. You literally can take a small account and multiply it. And I've shown that to you multiple times in the Discord server. There are links. I'm actually preparing a list of links that you can refer to whenever I mention things like that. So it's important you learn that. Now, I'm talking about early candles arbitrage now, right? Early candles arbitrage is understanding that regardless of your strikes that you're taking, because it's still at the start of the day, and especially if the market has not determined a clear trend direction, right? So it must not, well, the caveat is that it must not already have a clear indication that it is trending in a certain direction, which means there are no catalysts that is released yet. You understand that caveat, right? The market is still in some sort of indecision, still deciding at the start of the day where to go, still allowing all the orders that were placed prior, pre-market, or at the start of the day to be filled accordingly, right? So this is where the market is still in some form of indecision. At this point here, you can be certain that the intrinsic and extrinsic value of the options, especially in the 0 day to expiry, will remain quite intact. And this is why you can choose something that's extremely out of the money, fine, but you have to see its delta. Sometimes you take something that's really way out of the money. Now, be honest with yourself, especially when you have a small account. You're a poor trader, and that's fine, right? All of us start somewhere. You have a small account. You just got to know that you are a poor trader. For start, yeah. You are a poor trader. Not poor in terms of skill, but literally poor in terms of money. Now, when you know this, then you know your options are limited, and that's fine. Then be strategic, right? All of us started poor in one way or another. If you're born into a rich family, congratulations, you have your own challenges. But some of us, most of us, we started poor and we start scraping for resources, right? We start with what we have and we build them with our hands. So that's fine if you have very little money. But if you have that, you have to be honest with yourself, right? You do not choose options just because they are cheap. Something is way out of the money, all right? And it's cheap. That's not all you need to be looking out for, because sometimes if you take something that's really cheap, this is what, 0.001 delta or something like that. It's crazy low. And that's the market trying to tell you that there is only a 1% chance this gets there, right? So 1% chance means it's 0.01. All right, 1% chance, literally 0.01 delta. That Now, you know what this means, right? This means that when SPY moves 1 point, right, your contract only increases 1 cent in value. 1 cent, just 1 cent. You don't even see it, right? You lose it in the spread. You lose it you lose it through slippage. You don't even get a good fill. You can't even get a good fill. So understand the challenges like that. This is why, in order to get filled, you lose your money immediately. So you have to be more mindful, not to take something that's way out of the money, right? Now, if you're trading with a good broker, for example, I'm using SPX as an example, right? The denominations of your fill, it's probably in denominations of 5 cents. Let me just double check on this. I may be wrong. Yeah, 5 cents denomination. Yeah, you see that here. So this is my purchase price here. And this is SPX, mind you, right? If you're doing SPY, you have to divide this by 10. So you may not even have the last decimal point right here, right? That you have to understand that, right? So for example, if you buy something really cheap, something that's on SPX, it's 10 cents, right? Right. So you have your bid, you have your ask, right? Depending on your buying or selling, it doesn't matter, right? I'm just using it as an example, right? So this is your mid. No, you never fill at mid, never, because mid is, now understand this again. If you're trading, you need to know all these technicalities, right? The mid price does not exist. The mid price is a theoretical price. It's theoretical. It is calculated from your bid and your ask. In your order books, this too matters, right? Because these are real orders. There is someone bidding at this price and there's someone asking at this price. Now, if you don't know what is bid and ask, you have to go back to the basics, right? I can't teach you that here. I'm teaching you these, which no other videos are going to teach you, right? These are the real practical things that a real trader would teach you. Not from textbooks, not from AI, not from ChatGPT. Now understand this. The bid and the ask are your real pricing in the order books. The mid price is calculated from the average of your bid and ask. So some of you, when you buy a contract, you buy it at mid price. You don't get filled and you ask why. Or you buy or sell, whatever it is, right? And you don't get filled. That's because this price does not exist. This is a calculated figure from your broker platform based on what's on the order books of your bid and ask. Now, when you understand this, then you know if I want to, say, buy something, right? You certainly will fill at the bid price because this is what someone is asking, right? If you want to sell, you will certainly get filled at the ask because this is a lower price. So now understand this now. Bid does not exist, right? And you have your bid and your ask. Right, understand this. So for example, right, say my mid is 10 cents, right? Did I write 10 cents earlier? I think so. Right, and your ask will be 0.05 and your bid will be 0.15. Make sense? This is an average. So 10 cents will be your average between your 15 and your 5 cents. Understand that? Okay. Now, when you understand that, I want you to see the difference. If you buy something way out of the money, you notice, right? It becomes a larger percentage here. This is a huge percentage. Now, this is an example of something that is way out of the money, right? I want you to see the percentage. This is 50%, and this is another 50%. Now, if you bought it at bid, you immediately cannot sell at bid. Nobody's going to buy back from you at bid. You have to sell it at ask, and you immediately lose 10 cents to the dollar. Immediately, you lose your value immediately. And if your delta, say this delta here is 0.01 delta, in order for this price to move, SPY has to move what, 3-4 points? How realistic is this in order for you to start even breaking even for this ask to get back to 0.15. Understand this, right? Now, when you understand this, you will have understanding not to be going too deep out of the money. However, if you go somewhere that is at the money, in the money, for example, right? Your bid, ask, and your mid, right? So say this is $20, right? Your bid is 20.05 and this is 19.95. You see the difference? I want you to see this difference. This is how many percent again? Probably less than 0.1% difference. So if you get bid here and you decide, hey, this is a wrong move, I'm going to sell it immediately. There you go. You don't even lose much. You don't even lose much money. So my point is simple. This favors people with large capital. That's just math, right? You have to work out the math. The math tells you that if you are a poor trader, you have to be extremely, extremely strategic. You have to look at, firstly, your strike. Then you have to look at your delta, which is extremely important, right? And at the early candles, I always suggest this to you. At the early candles, minimally, you have to choose at least 2 delta. Minimally. Otherwise, you're not even moving the needle. You're not moving the needle, right? You may find yourself in a very difficult position to get out of a bad trade without losing money. All right. Now, understand this. When you understand this a little bit more, you have very good understanding of not over trading. Why though? Because before you even embark onto a trade, I realized something, right? I used the ask and bid. I think I changed position. Ask and bid, yeah. Sorry about that. All right. Okay. Yep. Anyway, let me get back to this. What I'm trying to say is, before you make a trading decision, you realize, before you even click the buy and sell button, there are layers behind your thought process that you have to pre-process. You have to pre-process these information and do a test by paper trading. Understand that. All right? When you understand that, then you will not rush into trade because you realize that there are deeper techniques to this. Now, once again, I want you to motivate yourself by having the table, because you're making money, you're trying to make money. You need to know how much money you want to make and know the realistic way of making the money based on structure. Now, you're fighting two battles, right? You're fighting structure, right? You have to trade as structure demands, and you're fighting your P&L. You do not trade your P&L, obviously, right? You do not do that, but you need to have a plan with your P&L. If you do not have your metrics of how much money you can make, you are never going to make it. You are never going to have a figure because, for example, this is how people overtrade. For example, if you've already made $3,000 for the day profit, this is great money, isn't it? This is great money. But you don't know if you've reached your limit for the day because you have no consistent metrics. What you're going to do with the 3,000? You're going to overtrade this, right? Because you have no idea of your table. You have no consistency in your trading. You don't know how much contracts to take. You don't know what's the delta that you usually take. You don't know what's the expected move that you have to take. You don't know what's the profits. That's your metric. You are going to overtrade because this $3,000 profit is arbitrary to you. This is luck. You got it because it's arbitrary. You understand the nature of the word arbitrary. I can't even spell now. Arbitrary. You need to understand the nature of that. This word appears when you do not plan for it. Then that number is meaningless to you. I don't care. You can make 2,000, 10,000, 3,000, 800, not 800,000 obviously, 800. I don't care how much profits you have. These numbers are arbitrary to you if you don't have consistent metrics, if you have not pre-planned your table. So that's the first thing you have to do, right? That's the first thing you have to do. You have to first come up with your metrics, right? I've shared my metrics with you before, right? My profits, if I've reached a certain percentage of between 25 to 45%, I'm done for the day, right? I probably will just take a small portion of this, right? So say I made 45%, right? I will probably take 20% of the profits and use that to make more conservative trades later if I want to, right? I've already got enough. This is my, in a way, my psychological or mental or physical limit, right? And I usually just aim for this in the start. It's easier when you have a larger account. Trust me, it really is. And I've explained that to you in terms of understanding, sorry about that, and in terms of understanding the bid and ask, right? As I explained that earlier. When you have a larger account, you can go deep in the money, your deltas quick, right? So I literally can make 10,000 if I take 50 contracts, for example, and it just have to move. Say 50 contracts, right? Let's use the same formula again, right? 50 contracts, say 50 contracts at, say, if I get something deep in the money, 7 delta, right? And it just have to move 0.5 points, right? Now you do the math from there. How much profit would that be? Well, let's just do a quick calculation here, right? Why do I make it difficult for myself with that 7 right there? Right, so this is around 35, 35, 3, 35, 35. Let's fire up the calculator. Calculator, where are you? Right, that's $17,500, right? This is $17,500. Done. So you understand that you have to work out your metrics from there. And I was talking about that in terms of your early candles playing the arbitrage. So apart from having something that's way out of the money, okay, apart from taking something out of the money, it doesn't matter in the early candles. You just have to worry about your arbitrage. Worry about your arbitrage. Okay, you understand that now. If you have a small account, try to take it with clearer structure because you will get good value sometimes, right? Because with the algorithms, you are able to see much clearer that the market have not already priced in. And you can take moves with precision algorithms. This is where your money makers are. Small accounts, this is where your money makers are. And also your final 30 minutes. These are where your money makers are. All right, so you have to focus on that. Now, let me take a sip of water as I catch up with the comments, right? Do let me know if you understand so far what I'm talking about. Just give me a quick shout out and let me just catch up on some of the questions there, yeah? All right. So work out this week, my challenge to you, work out your profit table. Try to standardize certain number of your contracts, right? And also looking out for the moves. You have to standardize it because you have no time to calculate it in your head to the detail. You can't. It's just not possible in the trading environment, right? So you have, I remember there was also one training video I told you, you have to look out for the range at the start, right? So you have a rough indication of how much of the expected move is going to happen in a day, right? So that's important. You have to figure that out, yeah? And then you know how much contracts you need to take, right? What is your move from there? Now, I'm going to introduce you to something called the liquidity wedge. I want to talk about that now, right? So I will move on from there. And just let me catch up on the comments before I move to the next topic I want to talk about. All right, let's go. Now, a lot of good detailed questions. I like that. Keep them. Keep these questions because I want you to also generate all these, compile all these questions and send them in the Discord if you can, right? Because I probably can't fully explain everything in a video now like that. Right, but if I have these questions, yeah, I will touch on them in the future. But some of the questions are can be quite technical. You don't need me to answer them, right? So do your own due diligence if you can. Right? I believe I can offer more than just technical answers. Now let's talk about spreads, yeah? Now, in a high IV environment, you have to understand what are you trying to take advantage of, right? You're trying to take advantage of the high premiums, right? High premiums. So basically, you're being charged more for buying options. So if you're being charged more for buying options, who will be the one making more profits? The person making the profits, in this case, simplistically speaking, will be the one selling the options, right? Or taking a credit from the options. You understand that? So the beauty of high IV environment is that you must have the ability to be the one that's writing or selling the options, and you're making the premiums. Now, there are caveats to this, of course, right? Because there is a reason why there are high expected moves. But that's the thing. Say it's high expected move. Now, just theoretically speaking, understand this in theory first. So when it makes sense to you, you can apply it practically, right? Now, when there is going to be a catalyst, so this is a spot price, yeah? Spot price. High IV prices in both ends. So far, so good. Do you understand that? And high IV prices in both ways. So your puts are expensive, your calls are expensive, right? Now, if you're an options writer, if you're selling options, you sell puts, you sell calls, right? As much as possible, they must be covered, right? So either cash covered or your position is covered, right? Try not to go naked. So you understand my point of view first, right? I'm selling on both ends. Now, the market can only move in one direction because the news is either favorable or unfavorable. Simplistically speaking, I know it can chop, but that's even better because I will get to there. That will be like the the final boss of selling options. But anyway, let me get to this. If it's good news, right, you make money from here, right? If it's bad news, you make money from here. If it's not good news, not bad news, you make money both ways. Do you realize that you make money anyway? And that's the beauty of it, right? So this is why, now you know why, the mainstream media likes to generate news. Because what they're trying to do is to artificially increase the premiums so that they can sell it to you. Do you understand that now? Do you understand the grand conspiracy of it all? Why do the news constantly bombard you with information? Now, when you can understand this, this is where you want to be. You want to be the one selling, because eventually you are going to be the one that's winning. You will win regardless, right? So I want you to remove the opinion that you have that you are trying to day trade, you are trying to swing trade, you're trying to make money by catching the direction. That's something I've been trying to inculcate to you from day one. Do not worry where the market is going. You will find profits in the charts. You understand that? Yes. So this is what you want to aim to do. So on Friday, there was a very simple way of doing that, right? And once again, if you are a poor trader, yeah, you can't sell options, right? Because you don't have the collateral to do that, whether it's your stock positions or cash. So when you're a poor trader, you have to rely on credit spreads, right? So you have your credit spreads. You have to depend on your credit spreads here. And that's fine, because for now, I want you to learn to practice, right? This is not where the big money is. Now, ideally, what I want you to do is to learn learn day trading, because day trading is where it helps you accelerate your money, right, with high leverage, by also managing your risks. When you have day trading knowledge as well, you can also use prop firms, right? You can get funded and you start making money with other people's money. Technically speaking, you're not using other people's money, right? It's simulated trading anyway, right? So you're just winning competitions. That's exactly just what's going on, right? So you're winning a competition that they set up and they pay you for that, right? So with day trading, you make money like that. Once you accelerate your wealth, then you start buying assets, right? And then you start to sell your collaterals, right? In this case, you sell options or you write options on your assets. This is the wealth cycle, right? You have some money from here, you put it back into the day trading machine and you accelerate it. And it starts churning and 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 churning. You have to get there. So be disciplined. If you don't see a trade for day trading, there is just absolutely no need to force a trade here. The reason some of you force a trade when you day trade is because you think that your entire identity, you think your entire wealth machine depends on this. No, it doesn't. Right? A lot of it is practice. Day trading, a lot of it is practice. You practice here. Practice, 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 practice. So I want you to learn. If you're a poor trader, you start by learning how to credit spread. Right? You understand what it means from here. Now, simplistically, once again, I like to make it simple because you have to start simple. If you cannot even understand it simplistically, you cannot understand the nuances behind them. You cannot fully appreciate it yet. So the same thing, if you want to throw a ball, right, you have to just worry about getting the ball out of your hands. You don't worry about the spin. You don't worry about the rotation of your body. Not yet. Nothing, right? The wrist, your body, no. That one later. You just worry about getting the ball out of your hands first. Same thing. Keep it simple, right? Now, the idea of a credit spread is that you're selling and buying at the same time, right? Now, the difference that you obtain is that you're selling something that costs more and you're buying something that costs less. So you're making the difference. Why do you do this? Because when you do this, you're trying to negate the increased premiums. Now, try not to keep the delta too far apart, right? When you keep the deltas too far apart, yeah, you may get a larger amount here. But as a result, you will get IV crushed as well. If you keep them tight, if you keep the deltas tight, you may be hedged against implied volatility, right? That's what you want to do. So you protect yourself both ways, whether for credit spreads or debit spreads. Now, both. Now, credit spread means, these are too simple, but I can quickly answer them in like 5 seconds, so I will do it, right? Credit spread means, the word credit means you receive money by taking that trade, right? Debit spread means you pay money for buying or taking that trade. So usually credit means you sell, debit means you buy, right? You're buying an option, you're selling an option, right? So understand this, you're good to go. This will help you do two things, right? Firstly, you reduce your delta, and so you reduce your cost. And so this is why, if you study some of my older trades, there is this thing I use called a dollar spread. I like to use this especially during midday when the market's chopping, right? Understand this a little bit more. I will be teaching you this. Right? This is a very important tactic that I have. It's called the dollar spread. Okay, this is important. Now, what you're trying to do, let me just explain the concept behind the dollar spread very quickly before I teach you about this next time. Now, firstly, when something is $1, this is a debit spread, by the way. So it's a dollar debit spread. Okay. Now, my stop loss is $1. So if I can buy something that's worth $1, well, I don't have to worry about my stop loss. You understand that, right? And this is why I can buy it midday and allow it to chop. Now, I buy this usually with earlier profits from the day. And if I see some possible moves that can happen, or there's some key targets that may happen, and the market is building liquidity towards that. Most times when the market is tapering, right? So that's a technique you can use. You can also mix strategy by having a dollar spread, which is cheap, it's only $1, while also selling contracts on both ends. So you're hedging something, right? Say, I buy a dollar spread that's a put spread, which means I'm betting that it's going down. And at the meantime, I can also be selling puts, right? Betting that it's going up. So I'm going both ways. Now, I want you to rewatch this again, and I will obviously cover this in detail, right? But once again, dollar, because this is my stop loss, so I don't have to worry about the expected move. And it becomes cheap because you're basically buying and selling options at the same time to reduce your delta and to reduce your cost. Now, I usually buy 2 strikes in between, because 2 strikes means my maximum profit can reach to $10. I want you to understand this now, right? I buy it at $1. The maximum profitability is I get to $10 if it gets in the money. So there is a possible for a 10x trade. If you take it for 1 strike, your maximum profit is $5, which is also a 5x trade. It's not too bad, right? And obviously, this can even get even cheaper, but this is it, right? 1 strike is the minimum you have to go. Now, you understand this, right? Understand this first. So you vary your strategies when you day trade, right? You have multiple strategies you can use for that. So far, so good. Understand this so far, right? If it's... let me try to work something out from here. Yeah, I will cover this in detail in another lesson. I want to run through my dollar spread trades so that you can see it in action. You can understand practically how it truly works. Okay. Okay. I think I will talk about this another time. There's something I want to talk about. What is it? Let me just refer back to my notes. Let me see. Okay, let me catch up with the comments in the meantime. Yeah. So far, you understand this? You want to know more about the spreads? Just let me know as well in the comments. Yeah, understand about the way they try to create more news, more speculation, so that your options premium are more expensive, right? You understand that, right? So you know your end goal, especially if you're a poor trader. Don't get sucked into it, right? Because you get sucked into that gambling mindset that you forget to see, right? If there's no one guiding you to the end, and here I am, I'm trying to guide you to the end goal. I'm telling you, don't be so short-sighted that you get lost right at the start of the journey. I'm telling you where the end of the journey is so that we can get there together. So if you're a poor trader, you have to make wiser decisions at the start. I'm sorry, but if you're a beggar, you can't be a chooser, right? And I can say that because I've been through that early in my life, right? I've had no options. You make do with what you have, and that's how you become a better person, how you become a better professional wherever you are, right? I can attribute that sort of mentality to how I got into my career in the first place, right? Because I hustle harder than others. I am more resourceful than others, right? I am the one that's willing to travel around the world and broker deals with others. Yeah, someone privileged can never do what I do back then in my job. No chance in hell. So yeah, God will honor you with the work that you do, with your upbringing that you have, with the portion that you're given, right? If you're a good and faithful servant with what you're given, right, you will multiply. So you are a poor trader, it doesn't matter, right? I'm telling you, it doesn't matter. You just work hard with what you have. You can't choose, and that's fine, but you will be honored, all right? So, okay, let's see. Right, I obviously know that there are non-members in the chat, so some of you shared the link. Please don't do that next time. Right, that's the reason why we want to keep this more collected, right? So if you have people in the chat watching this that have no idea what's going on, right? You don't watch me trade every day. It's never going to be constructive. And for the person that's sharing the link, you realize it's not constructive for you either, right? Because we don't crystallize that quality that is built over time when we trade together. You understand that. So please do not share the link next time. Yeah. All right. Now, next thing I want to talk about in the Friday. It's quick, right? It's been an hour. That's just too quick. Still lots to cover. That's why we have lessons weekly, isn't it? And this is on top of the price action lesson that I want to give you on a weekly basis as well. We don't have time. We don't have time. So busy trading every single day. The weekends is all we've got, you know. So trade with me every day. You'll learn something, yeah? Okay. Now, don't worry. I mean, some of you are asking real questions. I'm not doubting that you'll remember. But there are some that I noticed that you're not. So don't worry. I can't ban you from YouTube. So thank you for clarifying. I know some of you are legitimate and asking really good questions. Don't worry. Ask away. All right. So don't worry. You embody your own identity, right? No one should tell you who you are, what you need to do, right? You must have that self-confidence, that sort of security, right? Because you are worth it, all right? You really are. Now, I want to talk about the final. I got lost in my train of thought. I want to talk about liquidity wedge. Liquidity wedges are great, they're the best thing ever. Because you can expect big moves to come, but you just have to be very careful to get it, not trapped in it. And lastly, I want to talk about the final 30 minutes. Right, let's talk about the final 30 minutes. Okay. Now, by the final 30 minutes here, we have already identified some very key algorithms here, right? So one of the key algorithms, let's see, final 30 was about here. This was the final 30 minutes. Let's see, where was I talking about? Here. Now, by then, at this point in time, right, we have identified the pink, and I charted the blue here. Right, this blue became very obvious here. Now, you notice the liquidity wedge here, right? This became really, really tricky. Very tricky here, right? How do you take a trade here? Now, firstly, obviously, we had a very strong support level here. That's 687. And so, number one is if you wanted to short this, I remember instructing you, if you wanted to short this, you have to first see it break down right in the strong position. So unlikely it's going to head down. Very unlikely. Unlikely. Because we were also, as I mentioned, in that cup and handle in the 30-minute chart here, right? You noticed we were at the cup and handle. I told you about this cup of that 20-day moving average. Remember that? And we had that, and we were just building the handle on the way up. And it doesn't help that we are still strongly and firmly in that orange. Right, so taking a final 30 minutes as a zombie is extremely dangerous. I usually do not advise that because a zombie is not for granted, right? The best kind of final 30 minutes trade is if it returns to some sort of safety, or there is some sort of squeeze or dump, right? And when the squeeze or dump happens, the precision algorithm follows. That's the best kind of final 30 minutes trade. So you have to be all right not taking a trade sometimes. Now, I want to run through my thought process at this point. At this point, I see the wedge here. I have a very clear indication of how I want the trade to be taken. If it breaks out here, I will take it. If it's in the stronger orange algorithm, right? So at this point here, now let me just zoom it in. This is your best bet at this point. When it breaks here, and the blue, right? So liquidity wedge, and then you see the large green candle started forming, right? When it started forming now, if you truly wanted to chart like some really micro algorithms, you can definitely take this here, right? You certainly can. You see your risk to rewards, and it can be quite clear, especially once it started buying. But I would wait for this, right? And take maybe on the way up here, maybe take it here, right? This may look inconsequential, right? 688.71. So this is 688.71, and the top of the candle is 689. 6890. 688.716890. It's not great, right? I mean, take a look. It's not great. This is probably only 0.3 points. It's not even one strike. You understand what I mean? When you're taking a final, your final 30 or 10 minutes trade, what you're trying to do is you take something that is out of the money. You take a strike that's out of the money. So this will be extremely cheap, right? Because when something is out of the money, especially nearer to end of day, your delta is maybe 0.3, 0.2, it's low. But once you get in the money, right, your delta becomes 1, especially so late in the day. So this is why you get very easily 100% trades, 200% trades, even 10x trades here in the final 10 minutes. Because you can literally, from out of the money, 0.3, if it gets in the money, and not just in the money, it gets 1 point in the money, you literally from 0.3 become 2 delta. That's 7x. You understand the logic behind this? So basically what you're trying to do for final 10 minutes is to find something that's out of the money and get it in the money, right? So in order for this to happen, especially if you're trading SPY, SPX, right, it has to be at least 1 strike away. And 1 strike is 0.5 points on SPY. This is 0.5 points on SPY, equal to 1 strike. So getting something out of the money to in the money, you must at least have 1 strike. If you see the chart, it's not even getting to 1 strike. It's not even getting to 0.5 points. No, you don't take it, right? Maybe you can take this up to this candle. You probably can protect it 50% trade. Okay, fine. Right, this is still viable, right? If you protect early. Remember I talked about refresh rate? You protect the candle once it appears, right? That is the refresh rate. You do that. But otherwise, this is not going to be extremely profitable, right? You may even risk too much because once you get out of the money, right, it dumps to almost 0. If you don't take your profits fast enough, it goes from 1 to 0.3 as well. You lose value equally fast. So you have to see the precision algorithms following through. If this wants to head up, right, as I also mentioned, because your 20-day moving average is already there. Remember I talked about this? You probably see this happening, right? The breakout and retrace as well. So yeah, you can absolutely wait for that before you get into a trade. Now, you do see the orange taking control here. Yeah, you certainly do see that. Yes, this is probably a good trade too because it started retracing. My only problem with this is final 3 minutes. 3 minutes on a Friday. No. You don't waste your money like that, especially when the precision hasn't shown, right? Usually, if you trade with me long enough, there are some Fridays where once it breaks out, it just squeezes up in the precision beautifully for 10 minutes long. If you've seen trades like that happen, right, where the precision algorithm just continues for 10 minutes long, you're not going to start wasting money on things like that, right? It's the same logic. If you have seen enough good stuff, you're going to look at this and despise this, right? No way you're wasting money on this. So that's what I want from you. Some of you, you have low standards. I want you to have high standards. I want you to be less needy. You don't have to grab everything you see. You don't, right? Start looking for quality trades. And by quality trades, it means that you have to open your eyes, trade along with me for a longer time, so you learn to see what's good and what's bad. This is trash. Come on. Maybe some of you made money with this. But no. It's trash and you know it. All right? Understand that. I mean, yes, of course you can make money. Right? I can't even explain this. Are you that desperate to make money here? If you have to make rent tomorrow and you have to make this money, no. Keep the money. I don't know, man. What situation would you take this trade? You have to make rent tomorrow and you don't have enough. Either way, you get evicted. So you have to take a trade. Okay, fine. I don't know. How desperate must you be, right? So learn to identify. Firstly, how to see this? My comment here, right? What's my comment here? Let's see. Let me see my notes. Yeah, this. 2 strikes. I want 2 strikes instead of 1. 1 strike may not even guarantee you a very good move. 2 strikes, you get in the money, right? So you will enjoy the increased delta when you get in the money. Understand that? You understand that? All right. Now, when you understand that, it becomes so much easier. Okay. No, you don't take a trade here, right? So understand my thought process here, right? And know when not to take a trade. It's not just the liquidity wedge, because we also saw how, and I mentioned this, right? How to set alerts. We saw this level and we saw the 20-day moving average. So we were just literally pinned. Do you see how we were just pinned for almost 2 hours in that range there? Right? So you understand that now. One more thing I want to talk about, right? Spreads. Now, my credit spread, you notice something. I never leave it to expire. Never. Never, 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 never. You don't leave your credit spreads, especially if it's 0 day to expire, especially if they're naked. Try not to, right? You extract value from it. Usually, if it's 50% value, it's good enough to take profits. It's good enough, right? You extract half the value. So you notice it makes little sense for you to do naked credit spreads, because when you buy an option, right? When you buy an option, you're paying a price for the option, so your downside is limited. You understand that? It's how much you pay for the contract. And your upside is unlimited. Right? So there is value in buying options. If you know what you're doing, your leverage is high, this is actually fantastic for you. But when you're selling options, right, your downside is unlimited. Unless you're covered. So you have to always be covered. Or, when I mean covered, you're either covered by collateral or you're covered by strategy. Right? You know how to, for example, roll the option. Or you know how to manage the risk for your option. So you have to be covered one way or another. But your upside is limited. So it doesn't always make sense for you to sell. When you sell an option, it must lead to another strategy. What is my strategy when I sold the option here? When I sold the spread here? And I explained that to you. I sold the spread here so I can use that to buy my calls. Right? So I sold puts so I can use it to buy calls. Or you sell something so that you can use it to buy something else, right? You're basically trying to accelerate wealth. So don't be too one-dimensional, right? Just because you learn how to take a credit spread doesn't mean that it's the best thing for you to do, right? Doesn't mean that there's the only weapon you can use on the stock market. Now, the best thing to do, especially if you're a poor trader, remember this word today, if you're leaving with something you need to learn, it is to acknowledge that you're a poor trader and be proud of it, right? I will respect you very much if you're proud of it, right? Because that's fine. You will be the one that's learning the most, right? From all these, you will be the one learning the most. Now, if you are a poor trader, especially, don't just be doing something over and over again that doesn't work, right? I want you to be buying options instead of selling them. Credit spreads, you learn them, you day trade, you paper trade them, so you understand them a little better. But I want you to be focusing on dollar spreads. I want you to be focusing on final 30. I want you to be focusing on large structural moves. And this is why in my recommendations every day in my analysis, I will be looking at larger moves like that. And when larger moves don't form, right, you don't see full cups close, then there is no trade, right? You want to be taking micro trades, you take them closer to end of day, because then you will have a better leverage from there. Okay. Okay, I think this is quite enough for today. I do have another meeting I want to get to. So just let me read your comments one last time before I end today's lesson, quite a lot to cover, right? I will be talking a lot more about spreads, but there are general principles I want you to understand from today. Maybe basic for some of you, but it's fine, right? It's good to refresh yourself. And there are things that I've never taught you, right? So for example, like the table that you have to prepare for yourself. So even if you know it, do you have a table like that? I want you to prepare a table like that so you see that your trades can become more consistent over time. So this is your challenge for this week. Right, okay, now let me just read through the comments before I end today. Thanks for the moderation, Chacha. Thank you very much. I don't even... Can I see the messages? Oh, yeah. No offense, all right, some of you, if you're typing a question and it got moderated by someone else. It's meant to ensure the crystallization of quality here, all right? So don't take any offense. Everyone's trying to do good for each other. Yeah. Right, you can watch this video again, no problem. Right, just please don't share the link. It's just for you. Do not share the link. Right, and once again, right, there are a lot of things you can learn outside from other sources. But let me tell you, there are the things I teach you, right? They are like catalysts, right, in a chemical reaction. You don't find them elsewhere. But I teach you that 1% that you need to know, and it will unlock 50% of your skill. You understand that, right? So these are the things that you truly must learn from someone experienced, right? Otherwise, anyone can regurgitate from a textbook. Anyone can tell you something that someone else has already taught and said, right? But it's the real battle experience. It's the small things that you don't pay attention to, that nobody does, that I highlight to you, because the thing is, we're overloaded by information, right? There are millions of signals out there that your eyes and your eyes generally, when you're trading, is trying to pay attention to, but you can't. It's just not realistically possible for you to pay attention to a million signals. So you need to know what to pay attention to, right? And have the trust to know that those things that you're ignoring, it's fine. There's nothing wrong with that, right? So you see, these are things that it's precious, it's important, right? And I share them with you. And I don't worry, there are people out there who want to copy, who want to plagiarize, who wants to steal whatever I'm doing. It's fine, right? Because you realize at the end of the day, they don't have that catalyst. They are not able to generate that 1% power to create 99% of the reaction. I don't worry. I will stand the test of time because firstly, God is with me. And secondly, we're doing this with true skill that I want to impart to you, that when you have this skill, nobody can take away from you. All right? Understand that. Okay, so take your time. Don't rush this, right? Trading is very lucrative if you do it right, right? So there is no need to rush this. As I said, subscription is that amount of money, you can make it back easily. If you're not targeting to do that in one trade, now you're aiming too small, right? So the point of trading is that you want it to be a high income skill. Work towards that. That's why I suggest you the table. If you have not even calculated the potential of how much you can make, now you're not motivating yourself enough. I want you to start calculating. Once again, it's not an arbitrary figure. When I tell you $10,000, it's not arbitrary. I did it for you. Firstly, I did it for you to see it consistently. There was once I did it consecutively for 1 to 2 months, right? Just as a challenge to show you. And I can break it down for you mathematically how it's possible. Do the same for yourself, right? Start small, you slowly scale up to that. When you do that, you become less needy, you become less desperate, right? And you become very focused on what you want to look out for. And when you make that money, you will be even more locked in, you will be even more focused from there. Understand that? Yeah. Right. Yeah, maybe I would do the Q&A on Discord. Yeah, I would try that. Yeah, good suggestion. I'm organizing the Discord now, as you can see. I will share that with you in the other meeting that I'm holding. Right. Okay, thank you very much. I'll just catch up one last minute. Yes, thank you. Thanks for tuning in. Right, we got this. Yeah, I'm here every day, keeping you back in, whipping you in shape, keeping you back in your lane. You have to stay focused. Stay with me, right? We've got a long way to go. This is a journey, but just stick with me. You get there, right? The things that we do here, if it's just you and me, you don't have that sort of affirmation, isn't it? But we are here as a team. Right, and we are here to help each other. We are here to correct each other, right? And we are here to audit each other, right? I am also equally being audited by others who are observing me. So we have to go together as a team. Yeah. Yeah, thanks for tuning in. Yeah, all right. Do watch this again if you have the time. Thank you, and I'll see you later. Yeah, thank you very much.